Most people are using these money market funds the wrong way. Now, these are some of the best investments we have in Kenya. Hey, what's up, guys? So how do you use money market funds to get rich? Now, we are in these interesting times when, stocks are, crazy because of the tariffs and the markets are just on fire. There's a bloodbath and everyone is fearing like what's happening. And usually this is a good time to start thinking, okay, am I well diversified, right? Is my portfolio really balanced in a way that I can take in, all these shocks that come, especially if you're investing in stocks, you're investing in all these things that are currently, so unstable. And of course, even if you look into bonds, for instance, look into debt securities, there's a lot of instability and there's a lot of if you go specifically to Kenya, there's a lot of uncertainty about the economy, right? We don't know how the economy is doing. You can't really pinpoint to very clear trajectory of the economy. Are we really making money? Are we really improving? How is our GDP? How is our balance of trade? How is our, export levels going? How is our currency reserves, foreign currency reserve going? There's so many things that you need to look at for you to determine the strength of our economy. How is our production? How is our manufacturing industries? And how is money circulating in the economy? How is the inflation rates? There are so many things that are not very clear, I would say. And that is intentionally so because, things could be bad. And politically speaking, no one wants you to know that. Anyways, sometimes you need to understand how to use investments to your advantage. So how do you use money market funds to get rich? That's the essence of the video. Most people are using these money market funds the wrong way. Now, these are some of the best investments we have in Kenya. Because if you come to the West, we don't have money market funds in the same sense, the kind of interest rates we get, the way in which they are managed as well, the accessibility we have with our money market funds. We don't have the same thing, okay? So I do say one of the best investments that we have in a developing country are debt securities because they still pay a lot of interest rates. Sometimes, of course, they will be classified as junk or more risky or degraded investments in terms of classes, all those things, right? So because they come with risk, they come with the risk of a developing country. A developing country has a number of risks, okay? But still, these are investments accessible to you. And of course, with any investment, you will be taking some level of risk. So the same way you're going to take risk in money market funds, the same way you're going to take risk in stocks, the same way you're going to take risk in real estate. Right now, if you look at the real estate market that people always run to, there are loads of properties coming up. Everyone is trying to do Airbnb. It's falling, obviously, because there's too much supply in the market and there's not enough demand. Because demand for stuff like housing requires money and money is not in people's pockets right now. So, many things connected. So, I want to teach you in this video how to use money market funds to actually get rich. Things that you need to be doing, things you need not to do. Because a lot of you are now taking this as the holy grail. They're looking at money market funds like this is the main thing. This is it. Like money market funds, this is my investment. No, that's not how it works. And if you want to get rich, if you want to get ahead, you're not going to use one single investment that is giving you some good returns and think that's it. This is not it. Money market funds actually should be like the foundation of everything else. It should be the starting point and not the end goal. That's the main thing. Your money market fund should be your starting point, should be the foundation you build for your finances. And I'm going to tell you how. And it shouldn't be like this is the main goal. The main goal is like many other stuff. There are so many investments out there that you need to dip your feet into. As usual, this kind of Money Matters, we talk about the money mindset, how to make that money, how to manage that money, how to enjoy that money, how to invest that money, and how to assure yourself of a lifetime of income, basically financial freedom. Money market funds, they're good, they're efficient, they're secure. I've done loads of videos on money market funds, why you should invest in them, the risks associated with them, and I've basically spoken about every single thing you can imagine about money market funds. But now I want to tell you, how do you use them to get rich? Especially now that things are so uncertain. How do you use money market funds to get rich? So that you don't end up using them the wrong way and saying, hey, I've been investing in money market funds for so long, I don't see myself getting there. I don't see myself getting to my goals. It's because you're using them the wrong way. Money market funds, like I said in the beginning, is a starting point. I don't encourage money market funds as long-term investments. That's the first thing. Don't enter the money market funds investment as a long-term end goal investment. Why do I say so? Number one, with money market funds, we have fluctuating interest. It's very good because it's compounding money, but the interests are always fluctuating. When the interests are fluctuating, it becomes very difficult to determine a return on investment over a long period of time. And most of the time, as you have seen, interests will be going down, going up, but most of the time they don't stay up, they always have to come down at some point. So that fluctuation doesn't really give it a very good view in terms of long-term investment, because sometimes when you're going long-term, you want to have a more of like a clear, foreseeable future of like, hey, in the next few years, what is this capital going to give me in terms of return? You want to have some level of certainty, especially if you're going for financial freedom, financial independence. You're starting to think of like, okay, What could I get from my investments? Now, it's very difficult to determine that with a money market fund, obviously because of the fluctuating interest rates. Now, for a long-term investment, I don't encourage it because they can highly fluctuate. Like sometimes they are really volatile. You don't end up with the kind of returns you actually expected from that money market fund. So the first thing is, don't look at them as really long-term investment. They are not meant for that, and I don't think they should be. They should be used for certain specific purposes, which I'll mention, but not like your solid long-term plan. For instance, a retirement plan. And then there's the issue of accessibility, right? You can easily access this money. Now, when you're thinking of long-term plans, you don't want to put money whereby you can just walk out the door and see something nice, then you can go into your phone and withdraw the money. That accessibility makes it a bit too precarious for a long-term investment. Long-term investments should be something that conserves your wealth to a certain level. It should be something that is a bit difficult to liquidate in some sense, because as human beings, we know our nature. We want immediate gratification. Most people want immediate gratification. Actually, that's the natural state of a human being. That's the natural state of animalism. An animal, you want that instant gratification. We have to learn for us to delay our gratification, because now we're thinking of security, we're thinking of the future, we're thinking of tomorrow, because we are logical, intelligent beings. And therefore, in that sense, it's a learned thing. But our natural state as human beings is that we want that instant gratification. Now, with accessible money, chances are when opportunities come, you will spend the money. And that makes it really a precarious investment if you're thinking of it in terms of long term, because you want your long-term investments to be solid investments that are not easy to just go and liquidate at any point. You have to go through some hoops and loops before you get that money. Then there's the idea of money market funds are mostly, and the ones that gives good solid returns are like new firms. They are new investment firms. And when we invest in these money market funds, we are taking in that risk of the investment firm. It can fall anytime, right? They're just you and I coming together, forming an investment company, meeting all the requirements by the regulatory authority, and then we start that company. Now, anything can happen to the company. Most of them that gives very good returns, high returns, I would say, are not so solid. They haven't been there for a long time. They don't have so many products that make them stable. Their financial foundation or capability isn't as big. But of course, there are some that are like really big companies. They have other main products. Money market fund is just like a part of it. But in those cases, you find that they don't give you the kind of returns you'd actually expect, because they'll give you like 8%, 7%, 9%, because of that security they're giving you, that added layer of security. Now, that risk that you're taking with money market funds that give you good returns makes it also a disadvantage to invest in them long term. So think through that as well. Think of it in terms of like, hey, I'm thinking long term, yes, but what could happen to this firm? Will this company be here in the next 20 years? You don't know. The company hasn't been there for 2 years. How do you know that it will be there in the next 20 years? You don't even understand how it is managed. You don't understand the history of the people behind the company. You don't understand the history of how it was formed and where they want to go to, their goals and stuff, besides what they tell you on the website, right? So in that sense, you want to think of it in terms of like, this is a company, it can go down, and I don't want to put all my money, especially long-term investment, in this company. Those are reasons why you are supposed to think of it in terms of medium term to short term. Now, the second way to use money market funds is emergency fund. Now, I always talk about emergency fund, money that you can access that can help you insure your investments. How does it help you insure your investments? Because if something happens, because life happens all the time, your car is broken down, your house is leaking, your child is sick, whatever is happening, you've just lost your job or anything, you can get into your emergency fund without dipping into your investments, because the moment you dip into your investments, you've lost so much already. Money market funds can provide a very good pot for your emergency fund, a very good pot for your emergency fund. So in that case, you want to be in a position to cover those, those emergencies that come up in your life. But the best way is have them in an accessible place, but also have it as an investment, because the money market fund is still an investment. So before that emergency comes, hopefully it doesn't, your money is still earning you some money. And that's an advantage. And that's an advantage we do have. And that's an advantage we do have as Africans that we don't have in the West, because then you can access that money. It's also good interest rates. It's a good investment still, but you're still having it as an emergency fund, which you can easily access at any point. And you can also grow that pot as you want to grow it. So emergency fund, perfect use. Use it for emergency fund. Use it to ensure your major investments. Use it to ensure your long-term investments, okay? Plus, of course, the fact that they are secure. So with the emergency fund, you don't want to invest in something that's going to interfere with your principal amount. You want to invest in something that is giving you that security, that safety, that, my money is there for emergency. I have 200,000 Kenya shillings for emergency. There's no one day I'm going to wake up and find that 200,000 Kenya shillings is 100,000 Kenya shillings because of fluctuations. Maybe you'll find that you don't earn so much interest because interests are fluctuating, but not because the markets are fluctuating. So your principal amount is safe, and that secures your main emergency amount. in that sense. So you don't put your emergency fund in something that fluctuates. So if you had your emergency fund in a stock market right now, you know what's happening, and then you could be like, I can't even sell it. And then now you have an emergency and you can't access the money, you can't sell it. It becomes difficult. So money market fund, use it for emergencies, right? As an emergency point as well. Then short-term investments. Think of money market funds as short-term investments. Why? Number one, you can compound money. In a money market fund, you can put in more money. And every time you put in more money, the interest is on the new amount of money that you have and not what you had yesterday. So you can compound your money. You can compound your money over time. The second thing why you need to think of it in terms of short-term investments is accessibility, right? So with short-term investments, remember you want to access your money. Let's say you're planning to buy a plot, or you're planning to invest in real estate, or you're planning to do something in the next, let's say, 1 year, okay? Or even less than 2 years, you're thinking, okay, I'm going to need this money. But instead of having this money in a bank account, whereby I'm losing it to inflation, I would rather put it in a money market fund. So for those short-term goals, short-term investments, short-term objectives, you want to use the money market fund. You're going to be compounding your money. You can easily access your money with the short-term investments, and your principal amount is secure, because remember, you have a specific goal that requires a certain amount of money, and you're trying to accumulate money so that you get to that goal. So that security and that safety also ensures that whatever it is you're putting in there is always safe. So at the very least, you get to get your money out, and so that you can invest or buy or do whatever you wanted to do. It can be a life thing, can be an investment, can be something you wanted to do, but you have these short-term investment goals or financial objectives that money market fund could be perfect for. That's another way you can use money market funds. Then the next thing is medium-term investment. So let's say 2 to 5 years. You want to do certain things. You want to buy a car. You want to do something. You want to buy a land. You want to build a house. You're trying to put money together. Again, these medium-term financial objectives with very specific dates and time, this is a good place to put in your money, because you're like, I need this particular money at this particular time. So for medium-term investments, it's a very good place to stack money, compound that money, be secure and safe, and be able to access it when you want it. Then this is one of the most important points, right? The next one is accumulation point. Use money market funds as an accumulation point. This is a place to hold money, compound it until it is enough to take to another investment that would give you proper returns, stable returns, long-term investments. So use this as an accumulation point. Why? Because with money market funds, you can continue putting in money with time. You can put in money consistently, and the principal amount is safe as well. But you see, if you go into stocks, you could be putting money consistently, which is perfectly fine, but one day you come and things are like 20% down. And I don't think that's a very good place to be, especially if you're accumulating money to buy something proper. If you go into things like, let's say, bonds and debt securities, you'll find that there's an amount you need to put in for you to get some decent return. You don't want to put 100,000 in bonds and fix it for like 20 years. It makes no sense, because the returns are not going to be that great, and that money won't be that great when you get it in 20 years. So there's an accumulation point. You can compound your money, you can put more, and then have that pot whereby you just take the money and go and buy something. So like right now that stocks are on sale, that's what I say, you could have some chunk of money in a money market fund, transfer them into that specific investment and buy certain stocks. You can buy like a myriad of stocks that you couldn't afford the last 3 or 4 weeks, or I would say the last 1 month or so. So in that sense, it's an accumulation point, and a point whereby you're waiting for opportunities to come. This way you put money as you wait for great opportunities to knock on your door. These opportunities don't come so many times, so when you get them, you grab them, buy the whatever, and then you know what? You go. Then that also leads to the next point, which is use money market funds for compounding. Use money market funds for compounding. Now with money market funds, they compound. I've explained how they do. Use that to your advantage so that you get more money to put into other investments. It's a compounding point. Apart from being an accumulation point, you can use it as something that you use to compound your money. You're like, oh, I'm going to make money, but it won't be like a lump sum. It will be like, over time. So you can use this money market funds for compounding purposes before you then go into other investments as well. So compounding point is a different one from accumulation point. Now, the other important one is you can use money market funds to nurture good habits. Nurturing good financial habits, good saving habits, good investment habits. That's why you use money market funds. It's an efficient, easily accessible investment that you can use anytime. You can start nurturing those habits of investing. Investing is not something you wake up one day and start doing. You need to nurture that habit. You need to nurture that desire to be financially free. And the only way you want to see some results, you want to see the process, you want to get used to it, you want to understand it, is through starting from something very easily accessible, something very efficient, something very secure and safe as well, that doesn't fluctuate so much. So it's a good point to build that habit. It's a good point to start that process, but not a good point to stay forever. And then the last point I always say, this one is be consistent, be disciplined. With money market funds, you want to be consistent because you're using that compounding effect. Be consistent, be disciplined. And then, like I said, have a target goal. When it gets to that amount of money that you feel like this is good enough, transfer that money to a different investment. So it becomes your path, or what I call like a conveyor belt to the next investment. And that's how you use your money market funds to get rich, not looking at it as a single investment in itself. You will complain a lot because at some point you're getting like maybe 20 Kenya shillings as interest. You're wondering what the hell is happening. It's because the interest rates are fluctuating so much, and it's also accessible to you. You can look at it all the time. It's something you don't want with long-term investment. You want it to be something solid, okay? So let me know what you're doing with your money market fund in the comment section below, and let me know if this is helpful. What should we cover next? Till next time, I'm out.